Good afternoon, and welcome to today's webinar, hosted by the M&A Advisor. We're delighted you could join us here today. Please submit your questions throughout the presentation by using the question box on your screen. Our presenters will answer as many as possible at the end of today's interactive virtual session. If you encounter any technical issues, you could also contact using the same chat box as well, or simply hit help on the bottom of your screen. I'm Andrew Tardona, Managing Director with the M&A Advisor, and I'll be moderating your session here today. And now I'd like to go around the room and have our panelists introduce themselves. Let's start with Corey.
I'm Corey Massella. I'm a partner at UHY Advisors. UHY Advisors is a international and national accounting firm. Globally, we have about 9,000 professionals in 100 countries. In the US, we're about 1,000 professionals in about 22 offices. And our focus is really, we work a lot with private equity, family offices as clients. And we are very active in the tremendous amount of transactions that we do with many bankers, our platform companies, our PE groups. So it's a very active space for us, and we love it. And so that's why we're here.
Okay, great. And moving right along to Jamila.
Hi, I'm Jamila Willis. I'm a partner in DLA Piper's Restructuring group. I mostly work on debtor side engagements, but I also do a number of sell side engagements for distressed M&A.
Great. And last but not least, we have Ross.
Hi, Ross Gatlin, CEO with Profit Equity. We are a private equity firm that invests in strategically viable lower and middle market companies where we think there's a significant opportunity to enhance performance using a holistic system that includes financial engineers, consultants, strategists that combine together to try to optimize performance in companies using tools and techniques that we pioneered with some of the big Fortune 500 companies. It's been a good business. We've invested about $700 million of control equity that's yielded about $2.5 billion of value, a good return for investors, and I think a real positive impact on the businesses we invest in and the families behind them.
Okay, great. Well, thanks so much for joining us, and we're really looking forward to a great discussion here. And to kick that off, can you please speak to some of the ways you've seen the coronavirus shift key aspects of financial activity and how deals are currently being conducted?
Sure. I mean, I'll jump in right away, and I'm sure everyone will chime in. I've got a couple of deals in the market right now, and it's been very interesting to see how we've handled it. We've got two different advisors helping us with those situations. And as you might expect, there's a lot of video conferencing involved. And so setting up the initial management presentations, a lot of those were done virtually. There were even virtual tours of plants in many cases, and a lot of virtual work getting to that down select of groups before you go have the live meetings. In many ways, it's actually a number of people have commented it's more efficient in some ways with regards to travel, et cetera. And so as long as you get the front end work done and populating the data and have everything ready, then I think it can be incredibly efficient as a process, and it's worked pretty well. Now, obviously, these are businesses that have performed really well through the pandemic. So I think it could be different if it were a situation that were more complex, I suppose, than one where the companies tend to be outperforming, I guess, on a relative basis. But it has been interesting to see how efficient it can be despite the challenges.
Okay, great. And Jamila or Corey, would you like to add in?
Sure, I'm happy to. So to piggyback on that, just being in a virtual world now has been very interesting. I think there were some stumbling blocks back in March, but I agree that it's made a lot of things more efficient. It makes you rely a lot more on technology, but you also think, what do we really need to get this done? What does that team look like? How many people need to be on this call? Because obviously Zoom calls with 25 people aren't as efficient as Zoom calls with 3. Because I do a lot of distress M&A, a lot of that is before the court as well. So that entire process is also virtual. And the court has been great about sort of being able to push those deals forward. One of the things that we do miss out on a bit is in the bankruptcy world and the restructuring world, a lot of deals happen in the hallway right before the hearing, and we don't get that hallway right before the hearing anymore. And so we have had some deals that have been pushed into mediation to find a resolution before we go to court.
Yeah. So on our end, you know, again, like everybody else, we found a lot of efficiencies, but everything is virtual. We're on a lot more meetings on a weekly basis with a lot of progress. The approach has been different. We've added, you know, in our quality of earnings reports, you know, there's a whole aspect now of the creation of COVID sections, which we didn't, you know, it's a new world. It's a new world. And, you know, creating and coming up with these adjustments. And then as it goes to market, when the bankers go to market, the pushback that's coming back, people are realizing that you're kind of pushing the envelope a little bit here and there. And you got to get back to reality and where you can, you know, what you foresee as a forecast versus a little bit more reality. They have to be broken up. So there's been a lot of creativity and touch and feel to design the reports and from the this is on the sell side, from the buyer side, what their expectations are and what they want to see. So we're learning what the buyers want to see that's relevant during this time. And again, depending upon the industry, it's different for each circumstance on every deal.
Mm-hmm. And, you know, diving into that a little more specifically within that, have we seen any shifts in deal structures or new strategies to mitigate corporate risk as a result of the pandemic? Jamila, I know that as a distressed and restructuring attorney, you might have some different perspectives to that.
Yeah, there's a lot of things that we've seen that have sort of been new during this time. I mean, we called it unprecedented, but it seems now like the things we were calling unprecedented months ago are now precedented. So an example there is with MAEs, you know, whether or not a government shutdown would be material and what that means for the company, right? What level are they actually operating at? A lot of the buy-side deals I've done recently were retailers. Retail has been in distress for the last decade, and they've been having some trouble. But it's been kind of an opportunistic time for my clients, and they've also been heavily negotiating what the operations look like, right? How much should they be open? Even if the government is allowing them to be open, how many people should be in there, et cetera. So it's been very interesting to see sort of what they're accepting, what they want the company to look like while the deal is in place and while it's still being negotiated, and what they're trying to protect.
Mm-hmm. And Ross, any change in strategies or any add-ons from that?
Yeah. I mean, I'm not sure we have enough time to talk about all the changes. I'll just mention a few that stand out in this strange time. You know, one of the most interesting things I'll just comment on is the use of force majeure provisions in contracts. So rarely do you have an act of God that you can actually point to, and the lawyers will confirm. And so we have one here with COVID, and we've used it to successfully renegotiate a number of long-term contracts that did have force majeure provisions. It really allowed us to accelerate some really important synergies in a couple of deals where we could really drive a lot of value for the investors and do the right thing for the businesses. So those force majeure provisions are something to take a close look at, I think. Another area that we focused a lot on is swapping our interest rates. We do have a view that interest rates could climb in the future despite them being very, very low for a very long time. And so I think swapping that has been interesting. We had a deal we sold to a more traditional buyer that actually wanted to indemnify the entire purchase price, which some of you may remember deal structures like that. They happened quite some time ago. And sometimes people still want that type of a structure. And so I think we went and got, and this was about a year ago, I think it was the second, less than that, but maybe the second or third policy underwritten of a type of RWI that actually can indemnify the entire purchase price. And so that was a fascinating process, but we're using a lot of RWI and indemnification type insurance policies to really cover a lot of contingencies and complexities that you didn't have to cover before. And so that's been really useful and it's been an interesting thing. And then you've got these PPP loans and various Fed, stimulus, packages that they put in place, and how to handle those in a buy or a sell. And so now you have indemnification provisions around PPP loans for companies you're buying and selling and things like that you have to address too. So those are a few of the differences I've seen over the last 6 or 9 months that are a little bit unique.
Mm-hmm. And Corey, I know that, kind of under this umbrella, you've seen some combo deals going on as well, too. Can you kind of speak to that a little bit?
Yeah, I'll talk about the combo deals second. The first thing, as Ross mentioned, the PPP. PPP is causing some issues on closing deals right now because of change of ownership, and it's not clear how to manage that. And I'm getting a ton of questions on this, and and creativity in trying to do this. Asset versus stock, and what it means, and protection and risks. So there's not the clarity is not there, and the flexibility is really not there. And the bigger the bank that the PPP is with, the more complex and difficult it becomes. So, Ross is spot on that. Combo deals. So what I'm seeing which is unusual, is I'm seeing groups come in and do combo deals where they're buying 2 sets of companies at the same time concurrently in certain industries, because certain industries are kind of on fire under these circumstances. And so they want to do both concurrently. And that's been something that I really haven't seen before. So we're doing, literally 2 QOEs at one time on a combination with one group that actually got both LOIs out there at the same time that, the bankers had put together. So that's unusual. And, and some of it's been challenging, and there's a little sense of urgency because everybody wants to get it and get it done, because they see a hot industry and opportunity, and get everything in as quick as possible and keep the ball rolling. So that's been an unusual circumstances. And the last part is that we're seeing to close because of the contingencies, as everybody's indicating, the curse word earnouts, but they're calling it seller notes, milestones, but it's however you want to create it and call it. But there's more of it going on because of the drops, and you're also seeing some industries where the everything's come back better than earlier in the year on the multiples, but there's still a discount going on right now, slightly.
Mm-hmm. And that's all very interesting, and kind of ties into my next point here. I'm curious if you could all kind of pull out your crystal balls here. How is all this going to play into expectations for the months ahead? As we move towards 2021, early in the phases of 2021, we're obviously all expecting this to continue to have a major impact throughout, the market as a whole, strategic acquisitions. What are we really gearing up for in these next couple of months here? I guess we could start off with Jamila there.
Sure. So in the distressed world, a couple of the deals that I've been doing recently are for gyms and fitness centers, boutique fitness, etc. And frankly, even though in a lot of places gyms are allowed to be open, they're not going to be open at full capacity. So I think in New York, you have to be open at, I think it's 25% right now. But even when you go into the gyms, it's a lot less than that, frankly, because I don't think their customers would come back unless they felt like there was a reduction in the amount of people that could be there. And so what we're seeing now, I think that we'll continue to see activity in that space throughout the winter and well into 2021. I've also done a number of retail deals over the last decade. I think retail will continue to be in distress. Retail will continue to have issues. Consumer behaviors are continuing to shift. If there was ever an Amazon effect, that Amazon effect happened over the spring and summer, where everyone was home and ordering and expecting things to come the next day, and really looking only to buy on retailers like Amazon, Walmart, Target, et cetera, that could allow that to happen. So I think that our retailers will continue to have problems. If you look to see how Black Friday and the weekend after Thanksgiving went with in-person retailers and brick and mortar, it was not as great as they had hoped it to be. And I think that will also continue. So I think we'll still see a lot of distress in retail, a lot of distressed acquisitions there.
Yeah, I would just parlay off of that, you know, because the gyms I have are definitely distressed for sure. When they get open, get back, who knows? They're pushing the online and trying to fulfill and keep the customers sticky at this point and get a couple of bucks in revenue. Event planners, you know, those that do large events, they're also suffering too right now, and it's very difficult for them. Fortunately, I had a client that closed on March 2nd to Salesforce. He got lucky. So, but other ones are definitely having some difficulty. On the positive side, to Jamel's point, auto parts, you know, doing stuff at home, those are really flourishing. You know, we had one that just went into a SPAC recently, and that's doing really well. But the question is out there, you know, how long is the behavior going to continue? And, you know, once the vaccines comes out, will it continue? Will it amp up to the levels that these groups are seeing, why they're so hot right now? So 2021, look, you know, we all can have a crystal ball, but there's so many variables out there right now. We hope it'll be positive, but the industries that are suffering, we'll hope there'll be some fallbacks for them at this point. So, and then there's healthcare. That's another discussion onto its own. Sciences and healthcare. The money's just flying at that right now. So, and those are doing well. Those clients are doing phenomenal. So, Ross?
Yeah, I mean, this is such an interesting area. I mean, it's actually something I spend a lot of time on. I've been talking, I guess, for a couple of years about a coming downturn, and I think the metrics were all flashing red for the last couple of years. And then when you compare this to the Great Recession, we've now had a couple of downturns that have been different than prior downturns. Mm-hmm. And it really revolves around the unprecedented stimulus and lifelines that an activist, Fed and Treasury have been applying to the situation. And so you're not having a downturn like you've had, say, in 97 or 90 to 92 or 2001. It's different. It's like a very slow motion car wreck. Right? Like a train that's wrecking and the cars start to back up and twist way back along the lines. And it takes longer. And so guess what? There weren't these amazing opportunities in the first 3 months, right? They're not these amazing opportunities in the first 6 months. You had 33% more stimulus applied by the federal government in 6 months than there was occurred after 6 years of the great financial crisis. So unprecedented stimulus applied. And so you're not going to have the kind of, steep downturns and crisis type saves that you typically have. It's a sector by sector analytical path. Each one is different. Each one has a different shape, whether it's a V-shaped recovery like the automotive or the Nike swoosh like aerospace, or maybe it's a falling knife in some of these real customer facing situations where they've just been devastated. And so you really have to be more careful than ever. And then I think you got some macro trends that are fascinating, right? When you have this kind of unprecedented stimulus, it has to affect inflation eventually. And so you've got different groups like BlackRock that's coming out and saying, you know what, we disagree with the financial forecast of the financial markets, and we believe inflation is higher. In fact, we all know that there's different ways to look at inflation, and right now you would say it's higher. For example, if you actually count housing prices in inflation, it's 3% right now. So why do we exclude housing prices from inflation? Don't people buy houses? Why do we exclude energy from inflation? All these different things. I think there's a different view on inflation. When I look at our supply chain, when I look at freight costs, when I look at material costs, when I look at labor costs, despite all the countervailing forces, there's inflation occurring. That's going to start showing up. Anybody going to the grocery store for Thanksgiving knows inflation is present. So it's happening. And then you've got some structural changes that I think are different. And I'll try to be quiet. You have a secondary market that's different than ever before. You have $100 billion in something called the secondary market. And you have investors wising up to the concept that why invest in blind pool investments if I can invest in already existing assets? And you're seeing a sea change occur right now in private equity, where there's quite a bit of capital interested in recapitalizing and underwriting existing assets in the secondary market versus being as bullish on going into blind pool investing in this environment. And, the only problem is I think they're right. I think it is actually more conservative and probably more defensible to underwrite existing assets at this point in time, rather than leaning into the blind pool type structures that we've had historically, especially when you have an uncertain tax regime environment, right? And so all those things I think combine to have cautious sector by sector approaches, and each one has a different shape, and you've got to be more careful than ever.
And speaking to the upcoming tax environment and any changes in the administration, I wonder if we can maybe speak to what we're anticipating for the election results, and maybe any other additional things that are looming on the horizon from that. Starting with Corey.
Yeah, so we were on full alert going into the election. I think what's going to happen in Georgia is going to have a significant effect. Whether they get the 2 seats or 1 seat, but, that's going to affect, things like estate planning. We are on high alert. We're having discussions with clients that are up at that magnitude that really need to protect themselves, especially as business owners, because we can see a major shift there if there's a shift away from any block from the Republicans. Because that's going to be an area that is, I could definitely see the Democrats are going to come at that. And then there's the income tax side, on the personal side and the corporate side. We don't know where that'll land, and there's not much you can do right now on that level, other than do what you can, bringing into this year where you can, legally, okay, as opposed to the private company we see sometimes. That take things a little more aggressively, but yes, that is another area that that needs to be dealt with. And then the last part is our global clients, dealing with the profits and the guilty taxes and where there could be shifts there. We're addressing that too, but again, we're kind of not sure where it's going to land, and the percentage rates that we have presently. We're at 20-21%, whatever it may be, which is competitive. And if we make that shift, companies have been, the delta between our rates and being in Ireland or other ones has not been significant. So they're willing to stay here and set their global holding company here. Could we see a shift going forward? Possibly, but we don't know. But everybody's preparing. And just in case with a contingency.
Sure. And a lot of great points in there. Jamila or Ross, anything to add in on the new administration?
Sure. Just briefly, I just like Corey at the beginning of the year, we called it, a year of uncertainty. We don't know what will happen this year. We're not sure what will happen, November 3rd. Of course, after November 3rd, there was still added uncertainty, and there is even more uncertainty with the Georgia runoff elections. At the beginning of this year, I also worked on a deal that was interesting because of the tax advantages that it had, and who's to say whether in 2 years that those deals can even happen again. I think that we're going into more uncertainty with the Georgia runoff, and then whether or not the Democrats are able to gain control of the Senate, or whether or not Republicans maintain control of the Senate will give us a different view as to what will be able to be done by a Biden administration, especially with respect to taxes. I think he's already made some commitments, but you're not sure how aggressive he might be able to be. So I think we're going into a further period of uncertainty, even though 2020 has been an entire year of uncertainty.
If anyone can imagine more uncertainty, here we go. Ross?
Yeah, I think you guys nailed it. I think you're talking about taxes. And if you have a higher tax regime, it tends to imply lower growth. A lower tax regime tends to imply higher growth, tends to predict the shape of the recovery at a macro level, at least. Again, Nike swoosh tends to be more the high tax regime. V-shaped tends to be more linked to, low tax regimes. So I think that's kind of the high level effect. But then how does it affect individuals and corporations, as you said? So I've got people trying to buy companies by the end of the year because they're worried about the tax effect. It's not actually driving me as much as it's driving buyer behavior, which is interesting. And so that's definitely an effect. And then how does it affect private equity firms? I don't think people are talking about the truth yet about how important the change to the taxes might be for the structure of private equity deal making going forward. For example, why would somebody execute their new 10-year contract that could go 12 years in a fund structure before they understand the carried interest tax regime that's going forward? Before they understand taxes overall. I mean, this concept that everything's going to go on the way it's gone on, I don't know. That doesn't make sense. I mean, for people doing analytics, you're going to pause and wait to determine your structure before you understand the tax regime. But in the meantime, there's other things you can do that are interesting. For example, taxes really continue to be the tail that wags the dog, not the dog itself. What's more important than the tail? Well, how about inflation, interest rates, taxes aren't really going to drive things. What's going to drive things is where is real value going to be stored over the next 3 to 5 years? And I would suspect that real value is going to migrate to real assets to the extent currencies are debased. And so then you look at things like the Sharpe ratio, and I see some interesting things happening in infrastructure, in domestic manufacturing, in real estate that isn't commercial. And so I think what's happening is you're going to continue to see a transfer of value to real assets that's a bigger shift than the one we're focused on, which is taxes. So it's kind of an interesting time right now, and I'm finding some pretty interesting places to shift from cash, which I think is suspect as a store of value, to real assets, which I actually think it's the right time to move into those. Because to the extent currencies continue to have weakness or trepidation, I think that value easily transfers to the real assets, and I think it's a good place to be.
So I just wanted to, Ross, one thing you brought up, which is true, we see deals that are setting deadlines before December 31st right now.
Yeah.
They're hard, and then I left that out. There's an acceleration right now to get everything done with deadlines before the end of the year.
It's like we've become a Christmas business or something, or a holiday business, right? I mean, we don't do a deal until the fourth quarter, and then we need to do them all, and even more so this year than ever before.
Yeah, when all our people are completely worn out from the year to begin with. So yeah, and no one's taking PTO.
Yeah.
So, but the second part is, to your point, if there are adjustments in the tax rate, there's going to be a reshift of priorities. The state and local taxes are going to come back. And when you minimize that with where it's at, the delta is probably not going to be astronomical unless you're up at a real significant bracket, to your point. So you're spot on. That's just
you're triggering so many thoughts for me at this point. One other thing I should have said earlier. So I've got, I had a lunch this last week with some folks that are very involved in the governance of our state here down south in Texas. And I understand that there's 189 companies that are currently moving to Texas. And so again, this is happening in a lot of places, right? I mean, you guys know, there's a lot of people moving to Florida. There's a lot of people moving to Texas. There's a lot of people moving to lower tax regimes. And they're taking their people. And so it's going to be a tale of two cities. Like these different sectors have different shapes. Different states might have different shapes too over the next 3 to 5 years. This stuff is going to come into play. If you have 100, I've got stories of people going door to door, knocking on houses in the nicer parts of Dallas and Fort Worth to just buy a house. Just knocking on the door. Hey, I'd like to buy your house, because they're moving their executives there. We had 20 or 30 houses available in a very nice area, not far from where I live. And they had been sitting on the market, I think, for years. And they were all scooped up when one major company moved its headquarters to that area, and 25 executives all had to buy houses. So there's some interesting things happening with the movement of people and their business activities. And that I think could impact states differently.
Yeah, no, that has happened in the New York region. People have gone out to the burbs. We don't know if it's permanent. It's going to be a temporary. And then the next aspect is, how states are going to shift if everybody moves out of the urban areas, but they're working remotely, and will they start attacking companies to get funds related to the remote workers? Right now, it hasn't been solidified, but it's on the table for sure. If this, so.
Great, thanks so much for that. I want to let the attendees know that we're going to be moving over to our Q&A segment. And we have a great queue of questions ready, but if you wish to submit a question and haven't done so yet, please do so now. But to our panel here, I wanted to leave this with a bit of an overarching kind of closing thought. Is there any major discussion points or anything else, overall outlooks that you'd like to kind of bring up and cover before we move on to our Q&A segment? I guess starting this one off with Corey.
I would say flexibility, flexibility, and having contingency plans, whether it's three or four, but depending upon what industry you're in. And the key is the industry, as we've been saying all along. Every industry is different. Everybody's been affected differently, and regionally too. Depending on where you are in the country, we're seeing different aspects of how they're being affected and what's going on. So I think that the overall plan is going into 2021 is flexibility, and flexibility from a financial standpoint, cash, leverage, opportunities. There's major opportunities for those that are going into this year that are strong, and flexibility with your leases, how are you going to go forward, and your people, and what we have to give to keep our people, because everybody's getting into a different behavior mode. So we all have to be adaptive going into 2021. That's my major message.
Okay, great. And Jamila?
I would completely agree with that. I think, again, we're going to another year of uncertainty. I think it's important to be flexible. I think it's important to constantly look at what's happening and change your models and don't be wed to anything. There are many opportunities out there, and there's also a lot of capital out there as well. So I think that we'll continue to see a lot of M&A activity. I thought in March, I would have told you that M&A would be stalled for a while, and I think it was, but only for a few weeks, and people really got out there and put their capital to use.
All right, and Russ.
Good thoughts. Yeah, I think this is a time where I sound like that person. Maybe it's like my dad or something. I recall reading a lot about these guys, Graham and Dodd, and they had these old-fashioned principles about investing, something about a margin of safety, that we were supposed to be careful in our deal making to provide a margin of safety. And so sometimes that becomes very unpopular, and then sometimes it becomes very popular again. And I would say that right now it's become popular again to construct a margin of safety in your deals. Luckily, I've been careful to maintain a margin of safety throughout the deals we've been making. And I've become comfortable with being unpopular for periods of time and then becoming popular again, fascinatingly. But what I don't change is our approach. And so we've been buying things for purchase prices that really relate to collateral value, and then building value through operational improvements, not counting on multiple arbitrage and things like that. And that has led us to focus more on add-ons over the last couple of years, as a lot of the platform deals tended to be trading at prices that didn't have a margin of safety. And so we've been able to build some nice value during this time. I think it's a time to really focus on the basics right now and improving that margin of safety. We delevered our portfolio by about 20% in 2020. That was our crowning achievement, is finding a way to create more cash and drive debt levels down in the most challenging environment. We were also able to get gross margins higher during this time period. We were able to win share in some really important industries by having a better supply chain and being more flexible and adaptable to some of the things going on, and frankly, taking advantage of some missteps by competitors. So it's a time to be doubling down on the basics, the fundamentals, the blocking and tackling of performance improvement, and being very careful in your deal structures right now, and being very careful on the deals you do to make sure you have extreme conviction around the fundamentals of that business and its the opportunity going forward. So it's definitely a time to go back to the basics, I think.
Okay, great. And now we're going to be transitioning over to our live Q&A segment. And for our first question, how is this downturn the same or different than prior ones? We'll start with Ross there.
Thanks, Andrew. This one is pretty interesting. So I recall that in the great financial crisis, we were concerned about some important things. I recall that the leveraged EBITDA levels were unusually high, which was a little bit of a warning sign that there was going to be a problem. And I've got my handy chart here, and it says that in 2007, the leverage ratio for companies less than 50 million was 5.6. And by 2008, it was down to 4.5 and then bottomed out in 2009 at 3.3. Funny thing, in 2019, it was back up to that similar level. A little bit of an indicator that we were heading to a similar type of sort of a calamitous downturn. I also look at my average debt multiples of middle market loans, and they peaked at 5.6 in 2007. And then I was noticing we got to 5.6 in 2018. Funny, it seemed like maybe something was brewing even before the pandemic. And then I love this one about percent of first lien loans. Heck, I'll hold this up just for fun. Can you see it? The percent of first lien loans has gone 227% higher since the Great Recession. Almost feels like we didn't accomplish our structural changes necessary to prevent the next downturn. And then there's this one. Does anyone think that the highest amount of leverage loans in the history of the United States of America might be an indicator that things were frothy? I'm just thinking maybe $1 trillion plus of leverage loans when the 2007 level that we said was too high at 596 billion. If you double the amount of leverage loans, did you address structural issues about too much leverage, or did they get worse? And then, oh boy, don't look at default rates and what happens in recessions, because if you take a default rate, not the one they forecast, the one that actually happens, which tends to be low double digits when things really hit the fan. Oh, and you do the math on that. Oh, it's like $200 billion of loans that have to be restructured. And I don't think we've quite gotten through the 200 billion just yet. So, I think the warning signs were on the table, and I think this downturn was coming regardless. And so I think that, and then we talked about in the session, the response has been overwhelming, sort of monetary policy toolkit, 33% more stimulus applied in 6 months than was applied in 6 years following the great financial crisis. So that'll solve everything, no doubt. Injecting tons of money, keeping leverage loans at all-time highs. We didn't talk about the one covenant loans, did we? Those are also dramatically higher than they were. So the writing was on the wall. And what's different this time is all the lifelines causing the slow motion downturn, if you will, or the sector by sector capitulation, as opposed to the traditional boom concussion grenade downturn. Although I think some credit strategies were actually able to take advantage of about a 10-week period where the dislocation was severe and where good buys were made. So those are a couple of things. I know there's a lot to talk about there.
Yeah. Jamila, Corey, counterpoint?
No counterpoint. I would agree with that. I think that what's also interesting, when people talk about the downturn, we think, we're in a downturn now, and the pandemic sort of triggered that downturn. Well, right now we're still in the pandemic. And so what it has triggered, we have not seen yet, right? So I think that's also the difference here, where we had a couple of things that led to the Great Recession. We have a couple of things that are leading to this downturn as well. But right now, the pandemic is just one of them. And so what we're really in store for, we have no idea.
Yeah, and I'll just add, Ross is leaving out the fact that he put up that leverage part, out there. I don't know what period of time that was, but it's just gone up even higher. The great During this with the recession, interest rates went to zero. Everybody refinanced. Everybody went out and bought. Everybody, the people are putting 5% down. Gee, that was the alarm back then, right? 5% down. Those are risky loans. You got some of that going on, but at the same time, and wait, I'll just add on to that. The next part is let's talk about the fact that we have a lot of industries that are just hairline getting by right now, and we don't know what's going to happen when we turn into 2021 on these industries. We already know are hurting. We discussed it earlier, but how many are going to be going over into the bankruptcies or situations, and we're not accounting for the Great Recession was one thing, but we didn't see the lines that we're seeing right now where people stressed and looking for food. I mean, the people in hospitality, restaurants, those people are really in bad shape right now. And, we don't know the long-term effect of what's going on here because it's not coming out so quickly, and we're going into potential lockdowns again. So I don't mean to be gloom and doom. We will all come out of this. But, we still haven't seen the long-term effect of this. Granted, we're going to have the vaccines, but I don't know if it's going to be, we were talking the real effect will be in the second quarter, the end of the second quarter, maybe. At the same time, there's strength in certain industries that are just accelerating during these times that is a completely paradigm to during the Great Recession, and they're flourishing. And there's a lot of dry powder out there in our industry. So it's an opportunistic time, and it's to Ross's point, it's who's going to step up to the plate and be willing to really take the risks during these times.
And this really plays into our next question too, about the various stimulus and relief packages that might potentially come up. And I think, just speculating on that, on the last point that we don't know the full effect of the downturn or the virus as well, too. I mean, what are your thoughts on, as we go into 2021 with the stimulus or any sort of PPP loans?
I could jump on that, and then because it depends upon, this has been a hot topic, especially in certain industries. Let's talk about a staffing industry. In the staffing industry, everybody's been utilizing the staffing industry, and no one's, perms haven't been, everybody's utilized temporary staffing or utilizing outside agencies. Well, this stimulus really kind of saved a lot of them right now, in depending upon the industry. But they're looking to, what's going to happen. PPP right now, if anybody doesn't know, PPP is not clear on a lot of aspects. When you have your expenses, you can't take the expenses in 2020. That's going to turn into income. Are people going to have the money to be able to pay that income tax that's going to come about? Or did they utilize that some didn't expect? That hasn't been forgiven. There's been legislation out there, but it's not clear. The second part is on the larger amounts of PPP, where there's, the $2 million range or in those ranges, under the elections of forgiveness right now, there's a Never Land going on, which has to do with, and it probably won't be upheld, is that the expenses that you cannot, when you apply for the forgiveness, if you go in excess of what the loan is. Some people are reading it, they're saying the IRS is reading it, that those expenses you may not be able to take on your tax return in excess of your loan. Logically, that makes no sense. That's something that could be corrected. But there's gonna be stimulus. We just don't know. And again, we can circle back to what happens in Georgia and how that stimulus may happen. Or will there be action taken? There's been some secret discussions before Biden comes in just to Band-Aid, because you've got programs where people are going to what is it? Their unemployment benefits are going to run out right now. At the end of the year, there's some benefits that are going to run out. That's a dangerous place after what we just said before. So.
Yeah, the other point on how, various stimuluses have affected deal making at the beginning of, well, not the beginning of the pandemic, but back in the spring, when they first passed the CARES Act, PPP loans were not necessarily available to companies that were in bankruptcy. So there were a number of companies that had decided that they were going to go through a distressed M&A, they were going to sell themselves through a distressed M&A process, a public auction process, and then realized that they would not have access to the PPP loan. Some of them sued to say that they would have access to it, and other ones of them dismissed their bankruptcy cases so that they could get out and try to get access to that money. I mean, if there's available cash and potentially free cash from the government, it would be not smart for a company to overlook it. And so they were willing to sort of push down the line what the inevitable was so that they could have that available cash.
Yeah, there's so much. You guys are hitting all the high points. I'll just throw a couple of other tidbits on the table. One really odd one that Corey was alluding to is a number of relief packages and deferments and abatements through the CARES Act that are expiring at the year end. And you see some very intriguing prognostications about 11 million homes that would enter foreclosure in that situation. So currently down here in Texas, if you list a house for sale, you'll have multiple bids by the evening. And then you'll need to pay more than the list price if you want that home. So it is, we're in some form of a sugar rush from the stimulus, and it's being exacerbated by lockdowns and that people's perception that the quicker they can get to a house with a yard, the more they have some element of their freedom back. And so you have people moving to access that kind of space. You have people refinancing, recapitalizing, making, people that thought they were going to rent forever are now going to buy instead. And so you have some really interesting activity that seems to run counter to potential weakness in the future. And so I really agree with Corey and Jamila on this concept that we are not done yet. The other shoe has not yet dropped. And frankly, there are industries that are very protected, those that were very resilient and blossomed in the pandemic. It was an indicator that they are resilient and they do have interesting nuances that make them very protected. But for businesses that have been on the bleeding edge and have managed to get by, the next 6 months will be critical on whether there's a tipping point of sorts in some of these industries. And then you get into scenarios that are particularly concerning, where you might have a large financial institution come under distress or whatnot, triggering the sort of consequences that we're used to in this sort of downturn as an inflection point event that then causes other ripple effects and creates a little bit of financial market volatility and concerns that go beyond that particular situation. So, and then just a couple more things that I find intriguing is some of these things, have some nuances that it'll be interesting to see how they play out, like a Main Street loan. So I've talked to some attorneys that are pretty interesting who believe that Main Street loans can actually be portable. So, where are those interesting deal makers that are going to view that as a great opportunity for an LBO to come in and effectively buy and port over a Main Street loan? That's a pretty interesting idea for people that are trying to get leverage for their buyout. And so there are apparently ways to accomplish those things. And no doubt there will be different variations, et cetera. So this thing has a few more innings to play out before we see how it unfolds overall and in some sectors.
Yeah, and you bring up a good point, because the SBA, will they do PPPs or will they move to Main Street? They tried to adopt Main Street, it failed because the banks wouldn't adopt it and it wasn't working well for them, and it hasn't taken off. So that could be one of the that may be a part of the stimulus for businesses, maybe. Yeah. Don't know.
And we touched on the shape of the forward recovery a little bit earlier with that, but with all of these variables, I mean, is it possible that we might see different versions of that, whether it's K, U, L, V, as we come out of this?
Well, you left out ocean waves.
Yeah.
Sure.
Yeah, the S, the horizontal S, right?
Right.
Yeah, that's an interesting one. Yeah, there's no question, right? I mean, I talked about it a little bit. You know, aerospace is a swoosh; it's down and then slowly up. You know, housing is a rocket ship to the moon, but mostly if it's the different price points have different shapes. So entry level, I think, is very resilient. Higher price points have come under greater pressure, I think, in some areas. And then you get into some of these more interesting shapes that Jamila has been talking about, and Corey, where unfortunately some of them look like a falling knife in very customer facing situations, and that's particularly troubling because of the seeming sort of unfairness of it. From a macro perspective, given that those folks, frankly, were running good businesses, and I don't think they did anything to deserve that. And so it's, there's some. Usually, you can attach a little bit more logic to the shape of the curve in some of these situations than currently, and that's troubling, I think, for all of us.
Right. Right. Ross, I think one of the things that you said that was so brilliant really was that it's sort of a sector by sector recovery. It looks kind of like a slow motion train wreck. So what best describes it? I mean, all of the above, right? It's going to be a K for some sectors, an L for others. The falling knife, that's the L. The U, the V will also be there.
Yeah.
Yeah, sorry, I had some technical difficulties.
I thought it was the shape of my curve. It offended you.
No. You look, Ross, you're great at these, predictions and the economics of everything. So, I don't disagree with anything you said. And again, there's a lot of variables out there, and there's a lot of pressure, and there's a little bit of strength, and this is again a little bit more unprecedented than normal. So I don't have much to add to that.
Yeah, I guess the one other thing I didn't mention. Sorry, I didn't mean to interrupt you, Corey. The one. Sorry, we're at this point. We're just talking away, right? The one other thing I didn't mention, but I think you guys know it, but I just say it out loud, is this stuff affects smaller and mid-sized businesses much worse than large cap businesses.
Okay.
And that's the other sort of inherently troubling fundamental issue, because when you look at what's made America a unique economic engine, it is the unusual density of lower and mid-market businesses that is not like any other nation in the world. And so protecting that engine is critically important to the differences in America with regards to middle income wages and job growth and diverse economic opportunities for a very large swath of our society. And so those things, I would prefer to keep the sort of growth engine we've had relative to oligopolistic, structures that tend to have much slower growth and less vibrancy and upside opportunities for the vast majority of citizens. So, those things are, I don't mind a great opportunity and a smart way of doing it, but I don't like to exploit situations. And some of these feel like they could lean into exploitative type situations if we're not careful. And so at that point, I say let's focus on the greater good and help the gym owner and help the restaurant owner, and not just shrug our shoulders as those folks suffer unfairly, in my view.
Yeah, and I think you bring up a major point, which is the point that the difference between the Great Recession and right now is Great Recession was big business, and this one is affecting all the the core of America, which is small business, and small business creates jobs. Small business creates consumption, and the core of our economy is consumption and people spending, and the ability to lift everybody to the middle, and so yeah, I think and that's the part of that needs to be addressed in the stimulus. And then the second part is, which Ross, you'll jump on this, is how do we deal with the debt load, as we stabilize our economy. So,
yeah, don't get me started. I've got an old-fashioned view that maybe we should pay some of it.
hey, listen, we'd be an unusual country, right?
It's all right. I do have one very clever idea. We could swap some debt for equity. Anyway, in the end, we will find some balance sheet items will change their current place in the order.
Yeah, but yeah, I think just to shout out, we all have to support our local businesses as best we can right now.
Totally agree.
Right.
And a quick note to our attendees, we just have a couple questions here left. So if you wanted to submit a question, please do throw that in the chat box now. But our next one is, what is fundamentally changed or not, excluding COVID, between the GFC and this downturn?
Well, I mean, we touched on it earlier, so I'll just mention a couple of points I didn't the first time because I didn't want to drone on about it. But since I have the chance, I'll just say it out loud. I recall that we had this thing called Too Big to Fail, and it involved a few banks that were quite large and the concerns about something they called systemic risk. In fact, I recall both Democrats and Republicans standing on stages and saying that that was a problem everyone should address. And I'm not sure, but I suspect that actually that has only consolidated and gotten to be a bigger issue, much like some of the other metrics we talked about before. So, if we were asking if the patient has been cured of the primary issues related to the GFC, the Great Financial Crisis, some contrarians might counter that, in fact, we didn't change some of the fundamental things that we said were the cause of those issues. And if you haven't fixed the fundamental causes, then what makes you think the result will be different this time? I guess could be a concerning philosophical point to make. So it gets me tongue-tied. It's so concerning.
Yeah, I would, look, I think that the point was that there was too much power in too many institutions, and instead what we did was we rejiggered and moved that power into different institutions, except they're monitoring them a little bit better and they're doing stress testing better than they did before. But to your point, and what's the word I'm looking for? You brought up the whole syndication of mortgage-backed loans. And the fact that we went back to the low down payments and everything that goes with that, and then the risk that goes with exactly what we just discussed, and who's going to be hurt by that when should that not be supported in 2021?
Yeah, I mean, we got some beautiful bubbles that'll be popping soon. What about student loans? If we subsidize a broken educational system from a pricing standpoint and let's say value of the degree standpoint, I think people are calling that into question currently, rightfully so in some regards. If we subsidize it even more, is there the sort of pricing discipline in that model that will make it stand the ups and downs of economic fluctuations? Or do we have a little bit of a ticking time bomb there? It used to be a small issue. Now I've read that it's similar in size to subprime in GFC. So this little problem, the more we quit talking about it and ignoring it, the more it seems to grow over there in the corner. So I think that that's another one that, we're going to have to find a way through. So.
Mm-hmm. And Jamila, anything from kind of the legal side of things or any correlations you would make between the great financial crisis and what we're seeing here today?
Yeah, so I would agree that a lot of the underlying reasons for it haven't changed. I do think that there's a lot more coordination, though, amongst lenders and companies. So people now are going into court in restructurings, holding hands more often than not. Frankly, that's probably because it has gotten so expensive. Litigation is just so expensive at this point. And so it just makes more sense to go in with the strategy where all of the stakeholders are on board so that they can move forward. And in terms of distressed M&A, 363 sales under the bankruptcy code have gotten a lot more popular and much quicker. We talked about a little bit about how they can be effectuated in 30, 45, 60, 90 days. It's a very, very quick process. A lot of that is because the pressure of costs, and that has been a huge change from the Great Recession.
Okay, great. And our next question is, how is recruiting working or not during this time? So let's start with Corey.
The insanity of all this is you would think it would be difficult. We've hired almost 40 people during COVID, and we've been out there hiring. It's the same as dealing with our clients. It works. It takes more work. It takes a lot of meetings, and as well it should be, because you're not face to face. And then the integration of when you bring in people has been a little bit challenging. We've had some higher level people that have come in, that are just below our partner level, from Big Four companies, and the integration has been a little more difficult than we would expect because they're not walking down the hall with the integration and getting to know people, but we're working through it. And I could tell you Jamila, you could probably get to this, but at the upper tiers, it's much more draining up at our tiers, because we really have to manage the people more than we had to before. If at least that's how we're approaching it. And we want to make sure everybody's secure and comfortable, and a lot more communications and a lot more meetings virtually, because virtual and we originally went virtually with conference calls, and then we switched to virtual video, which was 20 times more effective, and we just stopped all calls internally, and we do everything virtually.
Yeah, we're also doing a lot of recruiting. I mean, there's a lot of activity, so we're busy. So Zoom interviews are not my favorite, but they have to happen. The actual process of hiring someone, I think, is easier than integrating. I agree with that. You cannot replicate just all of everything that comes with walking down the hall and seeing people and saying hello to them. It just can't be replicated. But I agree with you that video is better than conference call, and it's very, very difficult to do integration and management. But recruiting is still happening, and it seems to be working. And I think that we're going to go forward and try to hire more and more people.
You guys are hitting the high points. We invested in like a video conferencing system that was proprietary like 12 years ago, because we could, with our activist approach and the way we coordinate with the management teams and report out monthly, we usually would travel to the company every month, but over time that actually was inefficient. So we established video conferencing with a system that was secure. I noticed, for example, Andrew, you guys have seemingly a system that is unique and powerful. And I think, everybody sort of naturally went to Zoom, but I guess there's like some security concerns potentially with Zoom. And maybe we need to be a little more thoughtful about the security of the links, et cetera. And so that factored into our thinking. So luckily we've been they've grown with us, and now we've got a lot of flexibility in that system. And so it's been pretty seamless for us because we're already using it. The one change has been that we're probably getting, unfortunately, I will say, higher quality recruits and more of them than ever, because, in the past, if you got, 10 resumes, now we're probably getting 50 for a similar position. And then if you discounted naturally the inquiries from New York or California or further away places historically, because it's just less likely to come to Texas for various reasons, right? Well, boy, now that has flipped, and you can really they will tell you that they are serious and that they will move because they've been thinking about it quite a bit. So there's a level of determination around geographic flexibility that I haven't seen for maybe ever. And so there's real commitment to these moves and changes. And so, unfortunately, I will say we are, we're having to adapt to having more qualified candidates than ever. And one of the things we did, because of the things you guys mentioned, is I finally bit the bullet and did the big psychological behavioral assessment process and went to a data-driven approach. And we ran our whole team through it during COVID because, frankly, it's hard to take the time when you're running full speed. But once we were in various states of flux, we took advantage of it and did this behavioral system across our entire team, which then creates ground zero of our strengths, our capabilities, weaknesses, all that. And then it gives us a new data set for people coming in and their fit, because like you guys said, you don't have the same, interactions close up that you would have to maybe make a judgment about those things. And so we've added additional data, and analysis to that process to increase the probability across a wider, higher quality pool than frankly has been typical. So it's an interesting dynamic, but I'm sure it's not the same everywhere, but that's kind of what we're seeing right now.
You bring up a good point, and HR, and we started doing a lot of I wouldn't call it stress testing, but a lot of testing and discussions with people along the way during these times. Some people got into a funk. Some people got concerned. Some people were concerned that are we going back? But I had to get on phone calls. But a lot of that has been going on. Everything's kind of leveled out now. Everybody feels a little more secure. But at the same time, we did the behavioral, we did the difficult conversations. We had a lot of that going on. So, and these tools are critical, and they're really helping to bond the group, to keep it all together. When we did 200 people last night, a group call in a region to get everybody together. And we sent them wine and food for the discussion, different times, different adapting. Right. This is what we have to do. So, yes.
Yeah, it's really interesting. I mean, how many of those things have I done? When I was at Bain, we did, DISC. And then when I was at another spot, we did Briggs
Myers, Briggs.
And then, but it's interesting because, when you think about it, some of them are separating in 16 quadrants. Some get all the way to 32 quadrants. This one we found, it goes to 1.8 million.
1.8 million, huh?
I'm a convert, by the way. It changed my life, la, la, la. I mean, honestly, it really was a powerful tool that changed in some ways the way I think about my own characteristics. And really, I think was a very healthy exercise. So, maybe a silver lining to it all of some sort.
Yeah, no, definitely.
I'm a quadrant 4 on Bergstrom's while we're all sharing.
Yeah. I'm the guy that takes the hill.
And by the way, so your quadrants, it completely. What I did my DISC when I was at Deloitte and I had my own firm, and now I did it recently. I shifted.
Yeah.
So it changes at points in your life. So be prepared for that.
No, it's true. It's true.
I feel like it's just COVID. I'll go quadrant 3 to quadrant 4, just depending on the news.
Right.
Yeah. Well, I think that plays into the last question we have a bit and kind of piggybacks off it. I think we talked about some of the negatives of the current situation, but being able to get, better quality workforce and better applicants. I wonder if we could just go around quickly and talk about, maybe 1 or 2 more silver linings and end on an optimistic note of what we can expect as we move towards a vaccine in the next 6 months. Maybe start with Jamila?
Sure. So personally, for me, one of the silver linings is just the ability to be in multiple locations in a single day. So being able to attend a hearing in Delaware, a client meeting in San Francisco, and then, go back to Texas in the afternoon, something like that. That's been great. And not having to be on a plane every week, multiple times a week has been wonderful. The other thing that I actually think has been a silver lining is because we're all going through this, we're all really going through essentially the same thing during this pandemic. I think it really has brought my workforce closer together. It's brought me also closer together with my clients, which has been great.
Yeah, I would just say that, and as a result, with the PPP, we were completely, on like full throttle on that. We were working night and day, but the touch points of working with our clients, helped us show that we really care about our clients. got us closer with our clients, opportunistic, and that just built upon itself. So that's been a really strong point. At the same time that, as a professional service, fortunately, we reaped the benefits because we were busy as hell,
Right.
and the movement of the tax states kept us busy as hell. And, the reason we're hiring is because we're busy. What it's also helped do is because we're national, but at the same time, when people work in regions, they want to go regional sometimes, even if you have the qualifications on a national basis, they want to stay regional. That barrier has opened up. I'm working on deals all around the country right now, and it's all been remote. So it would happen normally, but not as much resistance as in the past. So that has helped tremendously and broadened everything. And I think at the same time, fortunately, strength, the strength, and, we're strong and we're lucky. We're one of the stronger firms. That has been opportunistic, and we're bringing in better talent that's starting to flourish in that we wanted to, and we needed it, which then just incrementally brings it up. I think there's opportunities out there. We were Debbie Downers before, but but only because we've been around the block, and we kind of are scared of what's going to happen. But we all come out of this. It's just going to be, there's a lot of opportunities, and we just want to see that, in my eyes, I know that a lot of my clients and a lot of sectors are going to do very well, and the gyms are going to have a rough time. The restaurants, the hospitality, the event planners, they're going to have a rough time coming back. The airlines, but at the same time, e-commerce, everything that's technology based, remote access, that's opening up. That was always there, and it's opened up. And how many tentacles are going to start opening up because of that? So there's going to be other opportunities out there. So,
yeah, I mean, it's something we used to talk about a lot, across a number of firms, is how a crisis and difficult situations can actually be your greatest opportunity. And I've seen that over and over again. Heck, it's kind of the story of my life, right? I mean, I ended up doing restructurings and turnarounds and performance improvements. And eventually I just said, gosh, why don't I just buy this value and do the work for the equity upside, as opposed to, and so those problems actually drew me closer to an answer that empowered me to feel more part of a solution, right? That I could actually change some of these situations for the better and impact people's lives positively. And I think as a human species, we have a spirit that is really, really special, that seems to rise to difficult occasions, and in some ways bring out the best in people during the worst of times. And I've seen a lot of that just over and over again. And our collaboration with management teams. I mean, Corey, you talked about it. I'm sure, Jamila, you see this. We have automotive companies that were going full speed, went to a standing stop, and then had to go back to full speed in 90 days. I've never seen anything like it. Right. And the performance of the management teams and our team here to facilitate that and work through it with creditors and investors and manage that and go from 100% to zero to 95% to zero over a 3-month period. It's the biggest V shape you ever seen in your life. And to have lived through it, it's like the Poseidon adventure. And, if you go through the Poseidon, I know I'm dating myself, but if you go through the Poseidon adventure with people, you come out the other side and you're a band of brothers and sisters. And it doesn't matter where you're from or, whatever, you're all in it together. The human spirit conquered adversity, and we came out the other side and we're better for it. And so there is that element going on. I think collaboration has improved. Some of them are case by case specific. I think the confidence it generates to overcome that type of adversity is contagious, and it can change people's lives. And so I think that we are building antibodies of a different sort by facing this sort of adversity together, and that actually bodes well for the future in some ways that maybe aren't as quantifiable. So I'm seeing people come together to really solve problems in a way that I have not always seen, and that is very encouraging. And I see it across, all types, and that's very, very satisfying and exciting, despite the fact that no one wants this. I don't ever want a downturn. I talk about they're coming because I want to tell the truth, but I don't want it. Nobody wants this sort of thing to happen. But you know what? If you see that a car crash is going to occur and nobody wants to do anything, then you need to go to the scene and put in protective things and try to help people. And so that's what's going on right now. If you see the problem and you hear the issue, then you're one of the ones that needs to go try to solve it. And that's I think bringing out some really good things in a difficult situation.
Yeah, I just wanted to say something about the collaboration, because now let's, and that is a very strong aspect of what's going on, and people learning to be flexible with people and learning to respect their personal lives. I mean, think about, for us, we've got a lot of parental people who are dealing with their children and their flex hours, and we're seeing them come offline, 3-4 o'clock and come back on at 7. Clients respecting that, and you can actually say that is what's happening. You wouldn't have had this before. Right. And people are respecting the aspects of what everybody's going through. And that's important. People buying homes, people having, issues, but everybody's respecting that and allowing the flex that, and honoring the professionalism or the fact that everybody's in this together. I think that's a really good point. That is probably one of the best things that's come out of one of the toughest times. You know what I mean? I really think that's been a real bonus point, and hopefully it continues going forward.
Well, great. Well, I think that's a fantastic place to call it. And we are out of questions here for today. So I'd like to say thanks so much for our speakers for joining us, as well as our attendees for registering here, and the ones that are viewing following as well, too. We at the M&A Advisor have a series of exciting award gala announcements coming up, so please stay tuned for those, and we look forward to seeing you at the next virtual session. Thanks again, everyone, and enjoy the rest of your day.
Thanks, everybody. Thank you, Andrew.
Thanks.